Hello everybody, March Mayhem continues with the banking crisis in the US. It certainly brought back memories of the global financial crisis 15 years ago, with what's happening with the Silicon Valley Bank, Signature Bank, and now First Republic. But I think the fundamentals surrounding this crisis is very, very different. 15 years ago, there was the issue with asset quality, with the the subprime and the subprime loans and the CDOs and stuff. This time around, I think there's no issue with the asset quality, right? Because actually, of these banks, they're just holding a lot of risk-free sovereign debt, the U.S. Treasuries. The issue this time around is actually liquidity, and of course the confidence crisis with the rapid rise in the interest rates. All the U.S. Treasuries now revalued much lower, and therefore, when the banks want to sell the treasuries to meet the demand for deposit withdrawals, there's a problem. So intrinsically, I think the fundamentals are different. 15 years ago, it was a worry because the banks were holding a lot of essentially worthless subprime loans and CDOs, whereas this time around it's just liquidity. So I don't think this is going to manifest into a big crisis. But of course, there's always a fear of contagion. So if a big systematically important bank like Credit Suisse goes down, is it going to affect counterparty risk and therefore a seizure in lending and stuff? So well, it's same, but it's different. But anyway, I've been hoping for a crisis, unfortunately, and this time around I bought more OCBC. So actually last week I bought OCBC and I talked about it over here in this video. It's a bit surprising that the shares are not down more, because I was hoping that the shares will be down like 5, 6, 10%. I can buy more. But so far I think the contagion has been very contained. At least for me, I don't think there's much of a contagion on the STI and the Singapore stocks. Rightfully so, because I think the local banks are very secure and safe. So there shouldn't be a problem. But anyway, I think OCBC is still a very attractive proposition. Gems galore is what I would say. So the big thing is of course the movement in the 2-year US Treasuries. You can see that actually a few weeks ago, or even last week, Treasuries were going north of 5%. And last week it went south of 4% to 3.78%. It's crazy, right? So like 1 week, the 2-year Treasuries moved 100 basis points, and now it's like around 420 or so. So it's crazy, right? This movement. Of course, this is all anticipation of what the Fed would do. Because of the banking crisis. Nonetheless, I still expect them to hike 25 basis points. Because they still have to prove that they are trying to keep inflation under control. If you look at the OCBC share price, actually at these levels, it's not expensive, but it's not really cheap either, right? So it's a bit of a dilemma for me. I was of course hoping that the banking crisis unravels and the whole thing collapses and can buy things much cheaper. But actually it didn't really collapse either. So in the end, I just bought something. So I bought in the first thing in the morning, I bought the 912.28, and then I was hoping things would collapse, right? But it didn't really collapse, and then it fell to 12.12. But then I didn't have enough cash, so I have to do all the bank transfers and so on and so forth. And then by the time I got some transfers in, it's at 11.95, and I bought a bit more. And then after that, I think it just rebounded, and it's been hovering around what 12, 10, 12, whatever, north of $12 ever since then. At these levels, 11.95, or it's not that cheap, but it's certainly not expensive either. Because you see during the COVID period when the MAS required the banks to cap the dividends, holding just collapsed, right? This time around, well, 11.95, okay. I was thinking like, so where would it actually be cheap? I think by and large, for the banks, it's a matter of the book value. So for OCBC, it's now 11.43. So if I bought it at 11.95, it's actually just above book, around book. So I think that's quite fair for the banks. It generally trades around 0.7 to 1.3 book would be the trading range. So this is just right in the middle, right? So I think it's quite fair. If you look at the financials for OCBC, it's quite very healthy. The capital adequacy ratio is at 15.2, which is the highest amongst the 3 local lenders. The liquidity coverage ratio, 152%, so on and so forth. I mean, just safe. I don't think there's an issue with the financial prudence of this bank at all. One thing though is that I was looking through the balance sheet and I noticed that there's some hidden gems on the balance sheet. So if you look at the balance sheet as of the annual report 2021, the 2022 results are not out yet. I mean the 2022 annual report is not out yet. So this is 2021. If you look at the investment property, 0.35, they have 800 million worth of it, right? Accounted for. But actually, look at 0.35 of the annual report. So 0.35. This is the net carrying value, right, of 800 million. But this is cost less depreciation, right? So this is 800 million. The actual market value is 2.8 billion. So actually, there's a $2 billion of hidden value on the sheets. So because they accounted for the investment properties at cost less depreciation, but actually the market value is much higher. So the excess is around 2 billion. So 2.8 minus 0.8, right? So around 2 billion divided by 4495, which is the number of shares they have currently. The excess works out to be 0.44, right? So the RNAV works out to be around 11.9, around there. So which is pretty much where I bought it at 11.95, right? So actually I bought it at around 1 times of RNAV. But nonetheless, I think it just shows that on top of all these very conservative and nice numbers, showing that the bank is well capitalized and safe, you also have a lot of value on the balance sheets. So in the event of a crisis and they really need money, they can always pledge or borrow some money against the properties, right? Or even sell the properties. So which is not gonna happen. I mean, the bank is just very safe. So well, I don't know. At these levels, I think for a blue chip solid Singapore bank, well capitalized, giving me more than 5% dividend yield, it's quite a no-brainer. So I just bought it. So I think some other viewers also bought it as well. So hopefully everybody will be nice and safe.